Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton, Director of Investor Education here at PassiveInvesting.com. And today we are joined with a very special guest, Gino Barbaro. Gino, welcome to the show.
Whitney, how are you doing today?
I'm doing fantastic. And you guys, we've had Gino on at least once or twice, I believe twice. And so, Gino always has an amazing story. And I am super excited to dive into his property here today. Before we do that, Gino, let's recap for our listeners about your background in multifamily real estate, why you're here and where you're at today.
It's a great question because everyone thinks that you're born a multifamily star, multifamily expert, when in reality, I was born a pizza guy. And I went to college and became a pizza guy. And it was with the family. And I loved it for years and years and years until the Great Recession came. And there's some parallels with that time when I started in real estate as to what's going on right now currently. So I think currently there's going to be some opportunities. But I started investing in 2009 when I met Jake in specifically multifamily. And when Jake moved to Knoxville in 2011, we partnered up and it took us 18 months to find the first deal. We bought our first several deals internally, just our own capital with another partner, and be able to refinance the proceeds out. We hit a wall around 2018. We ran out of capital. We decided to start syndicating at that point, syndicated a couple of deals, 3 deals. Then we stopped syndicating and went back into buying our own deals. So for us, it's just been one of those things where whatever, what you had said before, Whitney, whatever the market gives you is what you're going to take. And, syndication a couple of years ago worked really well for us. And now we're just starting buying deals internally.
Well, let's talk about that deal. Parke Villas, 62 units, Morristown, Tennessee. When did you close on this property and what was the purchase price?
We closed on it July 30th of this year. The purchase price was $9 million.
Awesome. Okay. So before the show, we were talking about that you had a really interesting story on how you found this deal. So tell us how you found it and what attracted you to this deal.
I think every deal that you do has an interesting story. And, I always tell my students, deals don't fall in your lap. You don't just get lucky. There may be a little bit of luck, Whitney, but there's a lot of hard work before that luck happens. And there's a lot of no's and a lot of relationships and a lot of heartache. And then it seems as if the heavens open up and this deal falls in your lap. But I still was resistant to this deal because Jake finds the deal. One of our great brokers in Knoxville brings it to us. And Jake is all excited. It's a Thursday before Memorial Day, and everyone's starting to shut down. And it seems as if we love doing business around holidays, 4th of July, Memorial Day, Thanksgiving. When everyone's shutting down, it seems as if that's when you get deals done. And he sends it to me, and I look at the deal, and I don't really look at it too well. And I see $145,000 per unit in Morristown, and I'm like, Jake, that's crazy. And I'm the cheap Gino. I'm looking at price versus value. And I discount this deal even before I dive into the deal. And Jake calls me back 2 hours later. He goes, Broseph, did you look at the deal? Did you really look at the deal? I'm like, Jake, honestly, I really haven't looked at it. Let me take a quicker look at it. And then I start looking at the numbers. I'm like, a 2018 build, really nice median income. We have 40 units right down the street from this asset. The amenities are great. The resident base is great. It was built really well. We're going to get into how it was built. Let's take a crack at it. It's $9.3 million. Let's offer $9 million. Jake says, I'm going to do you one better, Broseph. I said, how could you do better than that, Jake? He says, I'm going to send this guy a contract because I don't want this deal to go out to the market. And it had just gone out Thursday, and their broker didn't send it out yet. So Jake decides to send the contract over to the broker, his broker, for $9 million. Seller gets it. Looks at it. Saturday, signs the contract over, and we get the deal done. Our fear, Whitney, is if the deal had gone to the market on, Friday or Saturday, or we had told the person, yes, let's send an LOI, it would have sat all weekend, and he may have gotten a little wobbly and said, I don't really know. The first thing that you need to do is, if you're really serious about a deal, the verbal doesn't count. At the very least, send in a strong letter of intent. The second thing was, we could have gone, Whitney, and said, hey, we're going to give you 8.6. That's our offer. He probably would have said no, or we could have gone 8.9254. we just gave him a really good offer with the 9 in front. We took 300 grand off the price. We thought that was fair, but we wanted to lock this deal up quickly because we knew that once this deal hit the market, there were going to be groups out there that would like this type of asset. So I guess the moral of the story, there's a couple of morals of the story. Number one, always be out there talking to your brokers. Always be out there networking with them. Follow up with them. What's on the, and not only just talk about deals, just talk about the market itself. Get to know them. Get to be friendly with them. And it's not always, I mean, could you imagine if you had a friend who called you up and anytime he called you up, it's like they were asking you for something? After a while, you don't even want to deal with that person. It's like, I don't want to talk to this person. He's only looking for something. That's number one. Number two, when the broker sends you an opportunity, you don't just sit on it and go, I've got a W-2 job. I don't have the time to. They don't care about that. They're sending you the deal because they trust that you'll put in the hard work and they'll give you an answer within 24 hours. Jake did it within 3 hours because he knew his buy right criteria. He knew what constituted a good deal. He didn't have to go to his underwriting models and spend 17 hours on underwriting the deal. He saw what was there. He understood the market. He was an expert. He looked at his portfolio and said, Gino, we have to take a serious look at this. I think number three is it's great to have a great partner because I would not have done this deal by myself because I would have discounted it. Cheap Gino would have said price versus value. I probably would not even have looked at it. And I think the last one is do what you say and say what you do. We have a number at 9 million. Here's the contract. Let's go to town. If you want to sign it, let's get this deal done. And to me, it was one of those things it was just fate. And we got the deal closed, signed over the weekend. Tuesday comes, deal's locked up.
I love that story. And, I can really echo because especially like butting up against a holiday weekend, you get handed a deal or you find a deal. That was always been my case. Like when I was scaling my single family rental portfolio, at one point in time, somebody asked me, do you know when you did all your deals? And I went back and I looked at all the contract dates, not the closing dates. And I'm like, I
Yes.
put all but like 3 under contract between Thanksgiving and Christmas. Why?
Yes.
Because nobody was looking at them. Everybody's
Yes.
checked out. And so
Yes.
my competition was nil almost.
Yes.
I
Yes.
remember dragging my husband to a home to go take a look at it here in Colorado on like Christmas Eve. And the realtor met us. And I was like, again, that was the whole thing. It was just like, okay, this is an amazing home. No, if this lasts, it listed on the 23rd. If it's still available on the 26th, we're not getting it.
Yes.
Just not
And,
getting it.
and Whitney, that's the kind of broker that you want to work with. I'm sorry to cut you off, but that's so funny when people say, well, you took the time out. Well, that broker took the time out and didn't say, well, I've got to get food ready or I've got to go to church or whatever. I'm going to make the time for you on Christmas Eve because your business means that much and I want to deliver superior customer service. There aren't a lot of people out there that will do that. And that person that does that, I mean, you want to work with that kind of person, don't you?
Yeah, I mean, we were like, when can you do it? And she actually offered to us Christmas Eve, and I'm like, done, because if it's still here on the 26th, we're not getting
Uh-huh.
it. We're not getting this deal.
Mm-hmm.
All right. So you kind of answered my question on how you got to the offer. There's really no competition. You see this deal, or Jake sees the deal, puts out the contract gets signed. How did you structure it? I mean, I know you put the 9 in front, so you're getting really close to the sales price. But like how else did you structure the contract that you think might have worked to your advantage?
It was a simple contract. And to echo the sentiments, let's talk about this seller because we didn't know the seller. So we were just sort of taking a guess at what they wanted. And comes to find out, we go and do a walkthrough, an inspection of the property that next Thursday. So Jake gets on site with the seller and we're walking with the seller. And the seller is a builder who has around 800 units in Knoxville in the Tennessee area. And he says to Jake, my rents aren't where they're supposed to be. He only has maybe 10 employees in his property management. So we already know rents are under market. And the other great thing about it is that he is a builder. He builds beautiful product. There is no way we're building this product at 145 a door. It's a mixture of 24 3 beds and 36 2 beds. It's 20 triplexes. There is no way we're building it for 145 a door. He's done a masterful job. He just hasn't managed it as well as he should have, but he got into it for a very good basis. He built it really well. He started building it back in 2015. And when we're on site, lo and behold, he says to Jake, I've got another deal, a 67 unit. Huh. Okay. And that property was listed for $14.6 million. And when we ran the numbers, Jake said to him, like, listen, we're cash flow, investors. There's no way this number works at 14.6. And he says, what works for you? And, long story short, we ended up telling him 12 million, brought the price down. He went to 12.7. We ended up going to 12.2. We decided and we got that deal, that second deal locked in at $12.2 million. Now, the reason why I tell you this story and why it's really important is you're getting on site. You're building rapport with the seller. And if you don't ask the broker, does the seller have any other deals? That's one of the first questions you should be asking brokers. Are there any other deals? So we did a couple of really good things without even knowing. Number one, we didn't beat the seller up. We gave him the number that he wanted. Number two, we went on site, and when we did our inspections, we've got our CapEx guys, we've got the HVAC guys, we've got the inspector. We're going through the entire property, really telling him, honestly, you did an amazing job here. You've got a great property. And number three, we knew his motivation. We knew now all of a sudden he's a motivated seller because he has other projects. So he's into these deals at a nice cost basis. He wants to take his capital out here and move it into the next one. And during that inspection, Jake says, listen, I don't want to really give you a lowball offer. He says, no offer will insult me. And that's like music to your ears right now. And that's what I think going forward, we're going to see a lot of sellers who just want to take offers. They've gotten to these properties at good bases, or they're having a problem with their debt. And they're like, hey, listen, give me the offer. But none of that would have transpired if Jake did not tell me about looking into this deal, getting the deal done under contract, working really well amongst the brokers, doing what you're saying you're going to do. 3 days later, you're out on site, walking with the seller on the property, talking shop, building rapport, finding what their problems are, and you're there just solving the problems. Now, the structure of the deal, we did an 80% loan to cost on this property. We got a credit union, 5 years term, 2 years of interest only. And the great thing about it is we only needed about $300,000 in CapEx. And while we're on the property, there's very little to do, Whitney. I mean, there's a little bit of power washing, a couple of curtain drains, a little bit of mulch. And he decided to do the power washing and do those extra fix-ups. So he threw in an additional probably $30,000 worth of work that to him, it really doesn't cost that much because he already has crews. So for us, being on site and just being reasonable and just saying, let's get the deal done, and having that track record of getting the deal done and having the brokers talk really well about you all helps you as the buyer. So everyone's always focused on price, price, price. If you can focus on giving a fair and reasonable price, but you're also the person who's there who can close the deal and be easy to work with, that is a huge advantage in this business.
I love it. Now, I'm going to pull out a couple things or go deeper on a couple things.
Sure.
One, you said 300,000 in CapEx, and you're on site, you're walking the property. Tell us how due diligence went and what you were using the $300,000 for CapEx.
I love that question. When we looked at the property, built in 2018, on the bottom, there's brick curtain, and then there's wood paneling, nice brand new roofs. Now, reason why I say that is when you weed whack and there's vinyl, what happens to the vinyl? It gets all cut up. So the attention to detail is phenomenal. Wherever the dumpsters are, there's actual concrete pads. So when those heavy trucks go on there, it doesn't depress. Brand new parking lots, beautiful shutters in the property. The interiors are pretty much brand new. So when we talk about $300,000 in CapEx, if we have 60 units, it should probably take between $3,000 to $5,000 per, this would be a light turn. You're not going in there and doing a complete gut rehab on these things. They're only 4 years old. And when you have a higher and a much better resident base, they tend to take care of the property a little bit better. And the finishes on the property were better. The flooring was better. Everything was better. So on a newer property like this, we're doing this in-house. We're vertically integrated. So we're figuring, let's say $3,000 to $5,000 per unit. At 60 units times 5,000, an additional $300,000 that we are able to draw if we need it. And I think that's what people have to do. They have to be conservative. Now, if you're doing this with third party, it may cost you 7,000 per unit. So understand that. And on this property, what we really and truly loved, Whitney, about this property is the exteriors. There's very little, if nothing, to do on this property. We had bought a 1980s property that I think we had shared on one of your previous podcasts. Uh, Property is great, but it's an 80s build. And the exterior probably spent over $600,000 just on the exteriors with all the trees and the driveways and the gutters and a lot of repairs on the exterior as far as the vinyl. This property didn't have any of that. So if you're paying a little bit more for a property like this, it's okay, because in the long run, in 10 years, it's still going to be a relatively brand new property. Did that answer your question?
No, it did. Yeah, because I mean, you tapped into the $30,000 of work that the seller did, but I wanted to kind of dig in a little bit, like what your vision was for the property. And we talked a
Mhm.
little bit about this before the show. You kind of alluded to it here. You're not looking to flip this property. This is more of, we have that CapEx budget sitting on the side if we need to draw on it, but this is a more of a long-term hold. Should people be looking at long-term holds in this market? Is that what is
Um,
the market's giving operators right now?
it's a great question. And I think it's really personal to the individual, to their experience, to what I think their goals are. If you're just starting out in the business, your job, your number one focus, I think, at least in my opinion, is to create equity, is to build the equity. So you're in there, you're buying these properties, and if you can refinance them, great. That's what Jake and I did early on. We extracted the equity out and we put it into the next deal. But if you're in a market cycle where you can't, the BRRRR strategy, you can't do that. I think it's incumbent upon you to maybe flip that asset, pull the equity out, and get into a bigger asset if that's where you need to find your capital. So you have to look within and say, this is what I'm trying to accomplish. Now, there are certain deals that you buy that you're saying, I may have to flip this out and go into another deal. But what we love about this deal, and we talked about the buy right criteria, it is a burgeoning market. I mean, median incomes are exploding in Morristown. Everyone is coming in, as far as development, as far as retail, as far as job growth. It's amazing there. So we love the market long term. And like I said, the asset is new. So if you have a 1960s or a 1970s asset that you've bought and you've made money on and you're considering to hold it long term, we have a lot of those assets. Just make sure that you have additional CapEx reserves for those roofs, for those HVACs, for all of that, all the mechanicals and whatever else. Whereas this property, for the next 5 or 6 years, at least, we don't have to worry about any of that stuff. So as you're looking at your portfolio and you're cycling through your portfolio, that's what people have to understand, that multifamily, you guys do a phenomenal job of this. It's a business. You're cycling assets. You're repurposing assets. You're buying a 10 unit. Then all of a sudden you sell the 10 unit and go into a 30 unit. Then the 30 unit's sold and you go into a car wash or into a pickleball court. What you're doing is you're just trying to create an ability to get some type of equity and increase that equity, crystallize the equity, and start repurposing it into higher and better assets. I started out with a 1960s 25 unit Shamrock Motel back in 2013. A little over 10 years later, I'm buying a 2018 asset that's $145,000 per unit. If I put it into perspective, those 25 units cost me $600,000 back in 2013. Four units, 4 units in Morristown costs more than my very first deal of 25 units. So it doesn't happen overnight. The vision takes a little bit of time, but it seems to me is when you're getting into the business, you're buying those older assets that do have a lot more value. You can make more money on them. They do cash flow more, but they're a little bit more time, labor intensive. They're your little babies. They need more loving care. As you get older, you get longer into the business, you get into the teenagers, and then there are the young adults, and then they're off to college, and you don't have to worry about them as much. All right. They don't give you as much love like the C properties or as much cash flow, but they're a little bit less management intensive, and you can hold those for the longer term.
I love that analogy. Now you've already touched on the debt for us, but I just want to ask one more question when we're in the due diligence phase. Were there any surprises here, like any other physical due diligence surprises, or maybe even financial due diligence surprises?
There weren't. And the interesting thing for us was how clean the property was. We're used to finding some used to finding a little bit of mold, used to finding maybe some roofs, a couple of HVAC units that may be out. The only thing that we found was some drainage, and the buildings needed to be power washed. That was really the only physical due diligence. As far as the financial due diligence, the numbers that he showed were accurate. The thing that I struggled with was like, I can't believe this market's going to be able to produce. We went in with average rents taking over 1,100. That's what the average rents taking over. We're going to be going to almost 1,600 for the 3 beds and 1,300 for the 2 beds. So for us, and we've already achieved those. We've already gotten, I think, 6 new leases so far. So for us, it's always that fear of going into a market and having your pro formas and your projections. But like I said, it's a great quality product. It's a great median income. And for us, it feels as if, and I should have said this earlier on, but it feels as if it's almost like a build to rent type of community. It feels like an apartment community, like a residential home community where you're going to have residents who are going to stay there longer. I mean, they don't want to buy a home, or they're getting ready to buy a home, but they want to rent for the next 2 or 3 years. And they like this area. They like this neighborhood. They like the whole surroundings. And that's what really attracted us to this asset.
Mm. Now, if you would for us, recap the debt projections here. I mean, do you have a solid enough loan to hold, or do you have to refinance at some point?
Yes, great question. So the mortgage, $7.4 million mortgage, 80% loan to cost, 6.75% interest, 2 years of interest only. What we're going to do probably by the end of year two, we're just going to refinance this out to Fannie agency, Fannie or Freddie. So, and I think we could probably do it a little bit sooner than that because I think rates are going to drop by the end of this time next year. I mean, the 10-year treasury is going to be 3.25. We'd probably just refinance this, put this on stable, long-term debt. I don't know if we're going to go yield maintenance or prepayment, but this is not one of those deals where we're going to go out and cash out all our initial purchase. We'd rather be hopeful not to lever this thing up, keep debt at maybe 70 or 65% LTV, get the 30 amortization, get the 3 or 4, maybe 5 years of interest only on this deal, and just get this off and put this to non-recourse. That's what the debt's going to look like on this deal for us.
Hmm. Now, there's a delta here between the debt and then, the 9 million purchase price and the 300,000 that you wanted in CapEx. How did you
Mhm.
close that?
We funded it ourselves. So Jake and myself and my business partner Mike, all three of us had the capital from previous deals, and that's what we do. We don't do a ton of units. We don't do a ton of deals a year. I think last year we did 300 units. This year we're on tap to closing 150 units. So the deals that we do, they're just high quality deals, and we're also able to, have our employees invest in the deals. So our employees that are with us for 2 years or more, they invest for us dollar for dollar. And on this deal, I think we had a little over $300,000 in employee contributions onto the deal.
Fantastic. Okay, so which is a little bit different than a lot of people that we have on this show that do syndicate. So I
Hmm.
wanted to kind of ask a follow-up question. I mean, last time we had you on, you said you had a goal of like expanding your portfolio, I think, somewhere between 15 to 20% year over year, right? You guys are just taking a very controlled path to growth.
Hmm.
Are you on pace this year? This has been an interesting year. Are you on pace for that?
I think we're above expectations for 2 reasons. Number one, during the boom of COVID with rents, we fell behind a little bit on rents. I mean, in the Knoxville market, rents had gone up probably 25-30% in that 2 to 3 year span, maybe a little bit more. A lot of our districts had not caught up with that rent growth. We're finally starting to catch up right now. Fees have been coming in really well. Other income has been coming in really well. But with all these acquisitions that we have and adding these acquisitions on, if we're able to increase rents, let's say 3 to 4% a year with other income, and add on these extra 150 units a year, we'll be able to achieve 10% rent growth, a 10% growth year over year for us.
Mm. And what about, the growth for your entire portfolio, adding the number of units? Like, are you
Oh,
guys
great question. As far as number of units for us, we're right now at 1,700 units. We don't look at units. We look at profit per unit. That's what our metric is. So our PPU, our profit per unit right now, after all, expenses is around $300 profit per unit. And that's excluding the 200 units that we have on that we just took over because they're still in stabilization mode. But for us, it's not the number of units. We're looking at income. We're looking at gross income coming in the portfolio. That's how we're managing 10% growth. We're looking at that number.
now, since you've been in the industry, for over 10 years, and kind of seen a lot of different things, in the last 10 years, I'm curious to understand, where do you think we are in the market cycle and what can investors expect or operators expect over the next, 6 to 12 months?
The more things change, the more they stay the same. And it seems as if we're always trying to reinvent the wheel. When you go back in 2006, 2007, there was all that euphoria. There was cheap money, low cap rates, and everyone was jumping in. And then the crash came. And it feels as if that's what's happened over the last couple of years. 2020, 21, and 22, there was a lot of euphoria, a lot, a lot of optimism, low interest rate environment, a lot of people taking inordinate amount of risk. And then you couple in all of the money, you couple in the supply chain issues, you couple in the short-term debt. That's created a lot of problems in the market. And now they shocked the market by raising interest rates so quickly. I think the quickest in history. That didn't help. There's still inflation. Now, you don't know where jobs are right now because they said they overestimated jobs by 800,000. So do we have a healthy jobs market or don't we? I think, Whitney, to really hangs on that. I think it hangs on the fact that if jobs aren't healthy and we go into a pretty big recession, we're in the business of renting apartments. If people can't afford their apartments, what's going to happen? You have to drop rents. That's the key. And I think anybody who's over levered on their portfolio, that's where the risk is. And I think the other risk is if you're in an environment or a market where there's not a lot of demand and there's a lot of supply, in the short term, there's going to be a lot of issues. Let me give you a quick example. I was reading the other day of all the markets that have rent, rent, not growth, but actually rent declines. Raleigh, Charlotte, Nashville, I think Phoenix was in there. And the ones that all have rent growth, New York, DC, Indianapolis. And the difference, the funny part that I started laughing is all the markets that have rent growth, they all have rent control. And all the markets that have rent deceleration all have supply coming online and they don't have rent growth. So a lot of these markets where there's been overbuilding, it's going to take time for these assets to get absorbed. But let me tell you something, and there's concessions going on right now in the short term. But in the longer term, these are healthy markets. There are people that are moving to these markets. That absorption will happen. And then when you see building completely come to a halt, because of rates and all the multifamily permits. As far as the permits for multifamily over the last 6 months, they've just plummeted. So there's no new permitting going on right now. All the building going on, we're finishing it from COVID. Once all that gets absorbed, I think there's no way other than rents going up in the next, once that absorption happens in the next 6 months, that's going to happen. And then you have interest rates dropping and the money that's been sitting on the sidelines to jump back in. I'm hoping that people, if they're serious about getting into real estate and investing, take a look at the next 6 to 12 months because there's going to be an opportunity now. Pricing is still relatively high, but I don't see it going down that much more. But I think in the next, 12 to 18 months, if you bought an asset, you're going to be happy because I think interest rates coming down is just going to create that euphoria once again in the market.
Wise words. Well, Gino, thank you so much for sharing your knowledge and experience with us here today. If listeners want to connect with you and learn more about you, how can they do so?
Just go to jakeandgino.com. I mean, Whitney, if they want to start the journey, they can always email me, gino@jakeandgino.com, and I'll send them a PDF copy of Wheel Our Profits, our book.
Well, and I've read that book. It's amazing. Yeah. We got a little fist bump for those of you who are like listening on your favorite podcast player of choice. Well, Gina, again, thanks so much for sharing your time with us here today. And we look forward to hearing about your future deals.
Thank you, Whitney.